Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hey guys, it's Phil Tarrant here. I'm the host of the Smart Property Investment Show. I've been doing this for a little while. One of the regular guests I have on, he's been coming on now for, I reckon, 7 or 8 years, I would imagine. Sam Gordon. He's now the director, or has been for some time, of Australian Property Scout. You've probably seen him come into your social media feeds as a buyer's agent and property strategist. He originally came onto this podcast when he was but a humble investor. And he still is an investor, but he also works in this space as well. We get him on. He'll tell us he's one of our most popular guests. I say otherwise, but we're desperate. So every now and then we've got to dust him off when I hear he's in town from the sunny shores of the Gold Coast. Sam, how you going? You right?
Cool, mate. Very good, mate. Yeah. Very good. Good intro, mate.
What brings you into town?
Potties, mate. What do you mean? You called me down. Called me down.
Did I?
Yeah, a few potties, mate. Catching up with a few clients and stuff as well. So, yeah, mate, it was good. It's good to be back in Sydney. So.
Day trip?
Nah, here for the week.
Here for the week?
Yeah.
God.
Yeah. We're actually doing a few investor stories of our own tomorrow with a few of our clients on our potty as well. So,
really?
Yeah,
where are you doing that at?
We've got rented like a little studio, hired a studio for a day over at Alexandria, I think it is. Okay. So, yeah, it should be good, mate. That's cool.
What sort of investors you get coming on?
Mate, we've got a mix. I've got a young girl, young Ella. She's 25, just has built a 5-property portfolio over the last 2 years. So she's going to be a really cool story. And then we've got 2 other couples, both in their 40s, that have built pretty impressive portfolios. One of them's up to 8 properties, and the other ones, they've just clipped 20 properties. So
20?
Yeah, so they're going to be a really cool story to unpack and dissect. So yeah, really looking forward to it.
Wow. How does someone how long did it take them to get a 20 property portfolio?
They've been investing for a while. They've been working with me. I've been working with them for probably about 4 or 5 years now. I think it was probably in 2020 ish when I started with them. They had started with other properties in Sydney previously. I think they had about maybe 4 or 5 in Sydney before they started with me.
So a decent portfolio start.
Yeah, definitely. And they've sold a few of those off since then, but then they've kind of kept building since then as well. So they've built pretty aggressively, and they've pretty much just followed so much of what I've done in the way that I build mine and the different deals I put in my portfolio. Like, they're very open to doing the same things, big renovations, building grannies, things like that. Yeah. So they've built in a really aggressive
super
way.
active, right? Like,
very active. Yeah.
How old? In their 40s?
In their 40s, yeah. 3 young kids. So.
Still going?
Still going. So
God.
They got a few. We've got a few years of acquisition left. They, I guess, with where they live and like the school fees and everything, they've kind of got quite a big target that they're shooting for from a passive income perspective. So they want to build, obviously, quite a big portfolio, which then they'll consolidate down to owning, obviously, a smaller number of high cash flow assets that are going to provide the passive income they need for their goals. So,
it's not providing them positive cash flow at the moment. It'd be negative cash flow? It
is. No. I think it's about 40, 50 grand a year positive at the moment. We're going to run through the exact numbers tomorrow.
Yeah.
But yeah, man, it's like we're talking to be dead honest, the goal's 400,000 net passive. So obviously when you're building the portfolio, you need to go through a heavy amount of accumulation first, and you need to build out those cash flow deals. The growth properties need to go through their current cycles and their trajectories before reaching their peaks. You sell them back down, use the profits to pay down and debt reduce that portfolio as well.
And that's where you get your 400k.
Yeah,
positive.
that's it. Yeah, so that's where we need it. They kind of need to get down to that. So they've still got, I think it's in the game plans left, there's about 2.5, 3 years of acquisition left of multiple properties per year, and then over the next few years we'll start selling down as well.
What sort of stuff do they buy? Is it just meat and potato type stuff?
It's a mix. So we don't do meat and potato, mate. So we like they do have bread and butters in the portfolio, so good strong capital growth deals. But we're always doing like accelerator strategies. We might be converting things or adding different things, renovating things like that, forcing value, making sure we're timing growth markets correctly. They're the sort of basic sort of growth properties we're putting in there. But then we've done heaps of different accelerated sort of cash flow deals and cash flow strategies for them as well within the portfolio. So yeah, it's a pretty cool story. Mate. It sounds
good. I sit there and look at my portfolio and go, it's negative. I just don't want to deal with it. But it's hard to change, right?
It is.
It's really, really hard to change.
Yeah. I think that's where the consolidation piece is so important, and an exit strategy is really crucial. Like a lot of people
sell one property and then you're positive. You sell 2, you're certainly positive. Sell 3, you're absolutely positive, right? So just a matter of when you do that.
Yeah, and I think that's why you've got to build the exit strategy into your portfolio. I know you went through a sell down earlier this year or late last year or something.
2 or 3 assets, I think, just to free up some cash.
But it's a huge cash flow change, right? Because you clear like a high growth asset has gone through a huge amount of growth, but a lot of the time the rents have lagged to an extent, especially with interest rates going up as well. So you clear those, you clear that low yielding debt, you bank profit. If you pay down cash flow assets, like the transition can be massive. So
you can do, but you normally deploy the money elsewhere.
Exactly, and that's it. So it depends where the goals are and how much you still want to accumulate, or then if you're already there and you're just paying down assets. So.
Yeah, look, because and this is the smart property investment portfolio. There's like a couple of different trusts or 3 trusts inside of it, and some of them are positive because never refinance them, right?
Yeah.
You just go, these are great, don't cost me anything. But the stuff that you do refinance though, and you top up to 80, like it hurts, right?
Yeah.
Well, sort of hurts,
Yeah.
but you notice it.
Yeah,
But you
for
need to offset with other stuff. But anyway, that's the nature of the bit. Oh, that sounds like a good couple of days then.
Yeah, should be good, mate. I'm looking forward to it. I always love doing, mate. I love doing these with you, jumping in, having a bit of a laugh, and then you can't pass up the investor stories and unpacking their journeys. And
that's what people like. So they've got 3 kids. What do they like? Don't go into detail, but what do they do for a living? They must be earning reasonable sort of incomes.
One's an accountant, and the other's in sales. But the 400 is effectively replacing their income. So it's what they live on now. And this is the crazy thing. I mean, like living in Sydney, kids in private schools, that sort of thing, and forecasting what it's going to cost for the next 10, 15 years to kind of get them all through and out of school and everything as well. That's what they need to replace to be able to live at the same level and still be able to, but this is the cool thing.
It's hard to make $400,000 positive in property.
It is, takes some time. Yeah, for sure.
If you don't have debt, you can do it.
Yeah.
But if you've got debt, it's really hard.
That's why it's got to be built into the strategy, mate. Debt reduction is key. Yeah.
It takes time.
And that's why, mate, you always laugh when I get vocal about people who carry on about, never selling. It's just like, all right, do we want to retire in 10, 15 or we want to retire in 30 years? Because if you never sell, those properties we were talking about before, they have the massive growth, but the rents don't go with it. You're holding on to those. Like they're a bit of an anchor from a cash flow perspective, whereas they can be a super advanced pay down strategy. So that's why I'm very active with everything, buying, selling, renovating, all that sort of stuff. So
that's the way it needs to be. But you brought up something here, and you will see it in this, for those people watching this.
You brought the paper in.
I picked this up today in the paper, because there's actually paper, and it tells me falling rents point to easing of housing crisis. And I went, I've got to do a podcast with Sam today, so I'm going to ask him about this because you did hint on it there, and that is, you can be getting capital growth, but if you're not getting the rent moving at the same speed, which it never does. They normally operate counter-cyclical, right?
Definitely,
rents go up when properties go down, blah, blah, blah. But this point here, it says asking rents fell 1% across Sydney in the past 4 weeks, the sharpest monthly decline since the pandemic, in what could herald a broader slowdown in rental markets. This from SQM data. Weekly rents also drifted lower in Melbourne, Brizzy and Perth as vacancy stabilised, right? So this is the Managing Director of SQM Research here, Lewis Christopher. He said, while the rental crisis was far from over, rental growth was likely to flatten from here. So are the days of growing rents for investors over?
Look, I don't think it's fully over. Obviously, is this taking 1 month? This isn't a 12 month. This is a 1 month.
This is okay. Areas with the sharpest drop in asking rents, right? Northern Beaches, New South Wales, asking rents just over $1,000. Change MOM month on month, I imagine.
Okay,
negative 3.5%. Change QOQ, so quarter on quarter, 7.8%.
Okay,
drop of 7.8%.
Yeah.
In a quarter. So that's
other than the biggest
that's
one.
The sharpest. That's an actual drop in rents, not about the slowing of growth. Two very different things.
The one thing is, if we're talking about Northern Beaches there as well, it's a big price pointed market, right? Yeah. So like if you go down,
all right, Goldie next.
What are those? Goldie, yeah.
Okay. What do you reckon of Goldie? What's
Goldie?
Asking rent in a Goldie? Here we go.
It's a lot.
I
just moved a couple of months ago.
Okay, 857.90, right?
Yeah.
Imagine it's median. The change month on month negative 2.4.
Yeah.
Quarter on quarter, 5.6 negative.
Okay.
Eastern suburbs, New South Wales, asking rents $1,100 a week.
Yeah.
Month on month change negative 1.9, change quarter on quarter 5.3. Inner West, these are all Sydney. Inner West negative 2.6 month on month. low on the shore where we are 1.4% negative.
And so this is the thing that I find interesting about this, right? Is they're all expensive markets. So your expensive markets will always have that level of volatility, because if people are getting priced out of it and they're like, oh, you know what, cost of living's through the roof, where do they go? They go to the next price point down that they can afford. So this is where I really think it, and then that continues to flow down, right? Because as more and more people kind of get pushed out of what they can afford, they go down. You can't go up if you can't afford it. So this is where I think a lot of the time, you know, this is consolidated a lot of time to your more expensive sort of areas and cities and whatnot too. There definitely has been a bit of a slowdown this year in terms of rental growth. Probably in the last like three months, we definitely have seen a bit. But again, is it a seasonal thing? I prefer to look at it probably more from an annual than a month or even quarter. Quarter can be telling, but like over a year is something I'm probably more interested in. But again, they're the top end markets. Like you look at, all right, Gold Coast is probably the most expensive rental market in Queensland. All those rental markets in New South Wales, they're probably, you know, in Sydney, they're all probably the most expensive rental markets in Sydney.
Pretty much all. It is in Melbourne here, in East Melbourne, 1.9%. But this is saying,
again,
this is a drop in asking rents.
Yes,
right?
Understood.
So to my point is, it's very different to a slowing of growth.
Yes.
In rental prices.
Yes.
So this is where it's going backwards.
Yeah.
Rather than not going up at the same speed as what it used to go up, right? So I'd really like to see, maybe we can go get this data from
Big Louie.
And see what he says. His data in this stuff's generally pretty good. Also means that days of rents rising by 10% to 20% are now over, unless we see a major deterioration in vacancy rates, which I don't think will happen. And that's because of the lull in vacancy rates as well. Asking rents in Melbourne and Perth fell by 0.6%, while Brisbane slipped by 0.5% over the past. So this is what people are listing their properties for rent, and it's going backwards. So it just sounds like we've just hit the top of the market, and it'll plateau a little bit and taper.
And I think that actually is realistic as well with what we have witnessed. It's more of a plateau. We've seen a plateau. I mean, we saw Brisbane, Perth, Adelaide, 25% year-on-year growth for the last two and a half years, you know, like massive rental growth during those windows. So to see it slowing, I think it was always going to happen. A bit of a slowing and a plateau. Winter is always a slower period though. So it's going to be really interesting to kind of watch, even getting to the back end of the year. Does it stay slow and stagnant, or does it pick back up?
Well, you know, I guess if you can assume as an investor that you're probably not going to be raising your rents for the next period of time, that's okay. You should see some changes, therefore, in the performance of capital growth.
Yes.
Right? These things normally chunk around in cycles. But over the year, rents in Sydney lifted by 5.1%, Melbourne 6.4%, Brisbane by 5.7%, and Perth by 23.3%.
So over the year, we're still up in Perth by 23%.
23%, even though it's now come off.
Yeah.
So it sounds like it's equalising, and we're pretty much at the top of the rent.
Yeah.
Are you going to call it top of the rent cycle? Look at that loaded question.
Nah, man, this is the thing about
investing.
And exactly, it's always area specific, even like looking at those areas. But I think this is one of those things that's I prefer to look at something over like a full year rather than a month or a quarter, because it's seasonal. So many things can change as well.
Yeah, and by the way, I didn't tell Sam that we're going to talk about this. So just 6 months ago, Perth's rents were running at 20% annual growth, while Sydney and Melbourne were racking up double-digit increases. So we're truly off those large rental gains. At this rate, this is Louis Christopher. At this rate, rents will ease to single-digit annual growth very shortly, although they'll stay at these high levels for a considerable period of time.
I think while we're in the housing crisis, while we're in a stock shortage, I think rents will continue to grow, but it's going to come down to how soon that eases, and it's going to be condensed to specific areas as well. So I think probably that level of growth potentially that's behind us. Yeah.
Well, the thing is also you're now starting to see the impact of reduced migration, particularly from students coming in, and people are going. The university's going. Come on, like you've taken a very blunt. Look at how do you deal with housing crisis and by stopping this economic engine that fuels a lot of spending and stuff. So it's a bit knee jerk. Vacancy rates were unchanged over the month across the major capital cities. 1.7% in Sydney, 1.5% in Melbourne, and 1.1% in Perth. Perth remained at 0.8% and Adelaide 0.7%. So under 1% rental.
That's ridiculous.
So if you've got an investment property,
rents are still growing under 1% as well.
Yeah.
And that's why I think it comes down to city by city. Council by council. But sub 1% vacancy rates, you're still in growth.
Yeah. Anyway, so rents matter.
Rents matter. They definitely do.
Yeah. But don't expect to see huge increases. So I went through the process only the other week where I made sure all my rents were where they need to be.
Yep.
And because it's a lot easier now, rent management. It's a bit frustrating in that you can only really move your rents once a year, right?
Yeah.
Pretty much
With all the
everywhere these
reforms
days.
now, yeah.
So you lock it in, get it sorted out. So do you price in on that basis? And I want to get off rent because I want to talk to you about something else. But do you, when you rent out a place, assuming that you're going to have you can't move it for a year,
Yep.
right? Do you set your rent based on what the property manager tells you it should be set at, or do you always tell the property manager what you think the rent should be set at?
I always do both. I get them to tell me first. I'm always curious to see where they sort of come in at as well. But then I'll always do a temp check on the market. Always quickly check what's around the area, what's around the subject property in terms of other properties up for lease as well, and then make a decision based off that.
Okay. How often do you think the property manager get it right?
Oh, it all depends on the property manager. With my portfolio, probably 50%.
Yeah.
I reckon they're on, and then 50% of them are.
It's always under.
Yeah.
Yeah.
Yeah. They're always
by some lot.
Yeah, they're always.
So you got to
taking
work
it
your property
easy.
manager a fair bit,
Yeah,
right?
100%.
Sometimes. Yeah.
The issue with property managers, unless you're working with someone who literally manages, who is like directly invested in your portfolio. So let's say like a principal of an agent or someone that runs a small rental portfolio, something like that. The average property manager they don't have a vested interest in trying to get you top dollar. They have a vested interest in trying to make the job as easy as they can for themselves because they're on a pretty low wage for how much work they have to do in that role.
Tough job.
100%. So, unless they're directly going to make more from it, like the business owner might in that circumstance, they don't have that incentive to push for top dollar and deal with having to do a release and all the rest of it. If they can get a little bit less for it and just get it released with the existing tenants and then just, not even have to think about it, they're always going to take that option if they can. So, you've always got to be a little bit more on top of them than
you need to be.
Yeah.
Yeah, but be nice to them, right?
Yeah, of course. I got massive respect for property managers. They're
it's a
like we said before,
difficult job.
100%. It's a hard job, and most of them aren't paid that well. I mean, they're paid relevant to the industry, but compared to what they do out there, they're probably a bit underpaid for what they do.
And when you're saying, okay, well, I've got to set a rent for a year, right?
Yeah.
And this is the point because you're probably according to this article, you would assume that you're pretty much at the top of the rent cycle for this cycle, whatever it is. It depends whether or not you agree with that. But you're not going to be ratcheting up your rents considerably moving forward, right? So do you set it based on what market is today, or do you set it what market will be in 12 months' time when it comes off?
You can't call what it's going to be in 12 months' time.
I know.
So you got to rent it what you can rent it for in today's market. The tricky thing that we're seeing at the moment as well is there's a lot of areas where because they brought the new reforms in, something might be coming off of a fixed lease, and they might have say 3 or 4 months left since it was last released. Say is that 12-month period. So they're on market. If you're just looking and just checking what things are actually on market for, might be at say 400, but then you go into the ad and they're like, but in 3 months this will be going to 550 or something. So like, it can be, and if you're lazy with it, or if you've got a lazy property manager just having a quick look what's online in the surrounding area, they might actually miss what it's going to be jumping for, and so that is the actual market rent from that side.
So that's a good point. So because you can't move into you can only, I think Queensland is like this, irrespective of whether or not you got two different people living in the place on 6-month lease, you can only move the rent up per property, not per tenant. So that's when you say, oh, it's going to be $400 for 2 months, and then it goes up to $500. Yeah, and it's complicated.
It's
right?
tricky, man. 100% is complicated. They've made it quite tricky from that side, especially like having to lease something. Like you put something at 400 and it's worth 550. It's a weird. They're gonna get smashed unless people are reading it properly. It's definitely a tricky scenario, but it's where as a savvy investor you got to be on top of it and not just blindly trusting your PM who might just be taking the lazy option out or the quickest route out.
All right, I'll put this aside, but
Here we
it's
go.
good to
Big
talk
Louis.
about rents.
Thanks, Louis.
It's good to talk about rents because most people just talk about capital growth.
That's
right?
it, mate. That's it. Mate, it's the oxygen, right? You need it. It's the lifeblood of the portfolio.
It is. Welcome back, Phil Tarrant, host of the Smart Property Investment Show with Sam Gordon, director at Australian Property Scout. You may also know him from Scouting Australia
Thank you, mate.
podcast.
That's the one.
Yeah, which is popular.
It is. It's doing well.
And the School of Property. How's that going?
Well. Mate, really good.
Yeah?
Yeah, it's awesome.
Are you still, last time we spoke,
Yeah.
you said, I'm trying to think whether we had this chat on air or off air, but
Here
I'll
we
do
go.
it. I don't really care. That you're so subscribed in your buyer's agent's business that you want people to come through the School of Property in order for you to act for them in the buyer's agent business. Is that right?
Yeah, we had that chat off air,
Yeah.
but it's it is correct. So
Oh no, I'm pretty sure we had it. We had it
Did
on.
we?
I'm pretty sure we had it on air.
Okay.
Yeah, and purely because the education is great,
Yeah.
and it's sort of, it really shows you who's committed.
Man, I had an investor text me yesterday. He's been investing himself for 10 years, and he's come through and he's done the course as well as obviously coming through from the buyer's agency perspective. And he goes, mate, I learned more out of this than I have out of any course, out of any listening, out of anything I've ever done in my 10 years of investing. I learned more out of it, and it's completely changed the way that I'm thinking about the portfolio.
Yeah.
So really what we're doing is we're trying to drive education-driven investing. And for us, it's education-driven buyer's agency as well. So we really want our clients to understand how to invest at an elite level. Because there's so many different facets to getting this thing right. Like you can buy 1 or 2 properties and do okay out of it, but ultimately you need to build a sizable portfolio to get a sizable result. It's like we were talking about before, the 400,000 passive, even 150, 200,000 passive. You need to build a 10 plus property portfolio to get there. So you need to understand all the strategies and everything you need to do to go through the actual building process of that. And that's what I've pretty much broken down. This thing's just got everything within that, from all the different levels that I went through, all the mistakes that I made, all the wins and the learnings and all the different little creative pieces here and there that took my portfolio to the level I got it to. Man, everything's broken in and down through the whole thing. So really what we're trying to do is empower people to actually gain as much knowledge as they can around their portfolio and around building it out, so they can be as vested on the journey and understand really how to build it, man, moving forward.
Yeah, and so you'd much rather work with educated, committed, driven, passionate
Definitely
people.
What we find is those guys can make an instant decision on stuff because they understand where it fits into their portfolio, as opposed to maybe 1 or 2 chats and strategy sessions and whatnot. Like, they get an understanding, but they still might have cold feet. And so what we find is these guys doing it, they know exactly why this property is being presented, why it fits in the portfolio. They understand the process it's gone through. And yeah, mate, like 100%, because you think about, like, there's a lot of people that do tick and flick. Most people you probably have never ever seen an ad from Australian Property Scout on social media, Facebook, Instagram, YouTube, any of that. I doubt anyone has ever seen one, because I don't think we've ever done one, right? Maybe at the very, very start in the first year or something. And the reason for it is, every day of the week, I would prefer to work with, let's say, 100 investors, buy them 10 properties over a few years or whatever, and do 1,000 purchases with 100 investors doing 10 each, than 1,000 investors doing 1 property each, because they didn't understand the process. They don't understand what they're going through. I just need to cover overheads because I've spent so much on advertising that I just need to tick and flick and get these guys through. I don't want to work like that. We don't need to work like that. And I personally don't want to run the business like that. So if I can take 100 people and actually build them a sizable portfolio and build them a portfolio that'll get them towards their goals, every day of the week I'm going to take that. It's like these guys that I'm doing the interviews with tomorrow, doing their podcast with tomorrow. I've been working with those guys for like 3-4 plus years. Yeah. Like, I know their portfolios intimately. I know them intimately, and I much prefer that. Yeah, building a relationship like you and I have done over all these years, as opposed to walking in, not knowing you, not knowing them, trying to do a deal sort of thing. We're very, very vested in actually trying. I want to get people to retirement. I don't want to just buy a property for someone. It's not what I'm in the game for. I don't actually enjoy that. I enjoy the process of helping build someone's
and
portfolio.
therein lies, I think, a growing divide. I'll put it this way: a growing divide inside of the buyer's agent sector of people who, and there is a cohort of very capable people that see the world the same way you do, who
100%.
are there for the long-term value creation for clients around wealth, right?
100%.
And they want invested people, right? Invested in the idea of property as an asset class, but invested in the outcome, right? And to think that, I'll use a buyer's agent, they'll do everything for me, I don't need to know about it. I'd rather not know about it. I'll just pay them. Like, you're not going to get the outcomes you want. You want to be invested. So I get the idea of you want, this. You want to condition people through the school of property to be able to really understand what they're doing and therefore be decisive in their decision making. And I would imagine if I was a client of yours and you've been working with me, you've done strategy work and stuff, and you go, okay, Phil, I found you this property. Yeah, they should be able to say, just okay. You should present that to them, assuming they're going to say, okay,
100%.
I want to go ahead. That, and if they don't do that, well, you're going, well, something's wrong in the process. So you do the school of property.
Yeah, 100%, man.
Yeah. How often would a client go, no, I don't like that one?
The properties?
Yeah.
Oh, it's very minimal. It's very minimal. It might be.
Or I don't like that location. You've never told me a location you invest in your life.
Yeah. Well, that's the thing, right? So sometimes we get that. Sometimes people are a little hesitant on the location. But we always, I send out we have location reports. And I do a location video on everywhere that we buy in as well as the clients. So
how does that not get leaked on the internet?
It's closed. It's closed. Here we go. Just trying to get a bit of a better insight. But mate, it would be a very small number. Like no. You might get a couple a month that people are just like, oh no, like they just don't, either there's something about the deal or something about location, whatever they don't feel comfortable with. But mate, it's very, 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 very minimal. Most people kind of understand. And if there's something wrong with it, we just find out, okay, what is it that you didn't like about this, or what is it that doesn't effectively sell you on this? Like, why don't you want it? We just change the brief off the back of that, and then typically on the second deal, bang, it's done. Because we understand maybe the little thing that held them back on that one deal, but it's 99% of people, they get it, they understand what it's in the portfolio for, and they pull the trigger.
So the School of Property is really conditioning and training people. So when it's time to actually, inverted commas, pull the trigger, if you want to use an army analogy, they've done all the training.
25% of it would be about the the piece, because it's almost like it's just, but really the whole thing's education.
I don't know if conditioning is the right term.
Yeah.
That's a term I've used. You don't have to use that if you don't like it.
But I think I think this is the thing of like where the whole thing is supposed to be an education piece. But I think if you boiled it down, like 20 maybe 25% of it conditions them to the idea of like, yes, this will make sense because of these reasons. But the conditioning comes from the education. And so this is the biggest piece I find is the more educated you are, that you can make faster decisions, more educated decisions, better decisions that are going to get you a better result. And that's what I found. I even found that the more I did stuff in my it's like when I built my own portfolio, the more refined I got with everything that I did and all the mistakes that I learnt and all the good things that I learnt as well. It just made me get more and more refined. And this is effectively everything we can pass on. It's something at like 91, 92 videos in there so far, ranging between 15, some of them are a bit small. The foundation section's about 10 minutes a vid, but some of them are an hour plus, a lot of them are sit between kind of 20 to 60 minutes. It's just every time I have an idea that I think is deep and people will learn from it, and that I think is probably maybe a bit too much to put out in the public platforms, like something that I would teach someone in a strategy session, I'll make a note on it, I'll get in the studio, record it, bang, put it in there. We do monthly Q&As. The last one was a 2-hour session where we just sat in there. I think I answered about 45 odd questions of just the investors throwing anything and everything at me, and literally pretty much nothing's off limits.
Anything I asked you didn't want to answer?
Almost anything. The only thing like that we kind of we do keep within is just when it comes to locations and the sourcing piece, just because like we don't want to create unnecessary competition. And obviously that's
fair enough.
And that's the only bit that we effectively
I found out where they're buying now. But location is part of it, right? It's not all of it.
It is, of course. Yeah, of course. Yeah. It's like forever everyone's always said, obviously, like finance is 50% of the game, property is the other 50%, but like, I would argue very much a strategy is another 50% if we're going thirds, on this thing too.
Is it a game?
Property?
Yeah.
100%. Yeah. Levels. There's always levels. So I think anything that's got levels in a way is a game, because you level up as you go through everything. Everything in life to me is that. The
gamification of it.
Yeah.
You've been watching the Olympics? No.
I watched one race.
Yeah.
One of our clients, Saya, won the gold medal. The BMX racer.
Oh, really?
Yeah. Oh, that was the one I watched. I was so busy. I didn't even really know it was on. Yeah.
Really?
She's actually really cool. Yeah, she's champion.
Are you allowed to disclose that?
I don't know.
Right?
I don't know. I might check with her after. So, yeah.
That's cool.
Yeah.
Get her on for a chat.
I probably should, mate. That'd
be really, really good. Yeah. How old is she?
24.
Okay.
Yeah.
Wow.
She's killing it, yeah.
Killing on the track.
Yeah.
And she's probably got. How much do you get for a gold medal win?
I don't know, mate. I'm not going into that.
She just won a deposit.
Probably. I probably shouldn't go too far into this. We'll leave that one.
No, we're going to leave it alone. I won't have a chat with her. She wants to come on and have a chat. But congratulations. Let's pass on that.
Yeah, 100%.
That's absolutely brilliant.
She's a champion.
Yeah, no, brilliant. And if we can stitch this out, if you say don't
I'll check with her after. I was chatting with her this morning actually, because we're in the process of buying the next deal at the moment.
Okay,
so,
all right. Yeah. Well, no, we value we value discretion.
Yes,
on this property investment show, and privacy. But for what I do notice, and you're down in Sydney recordings and stuff, that people who are into property and property's been good for them.
Yep.
Often are very happy to share.
Yeah.
It's when people probably haven't done so well, right? You've made a living out of it.
Yep.
You're you do it and you help clients do it. I guess I've sort of made a living out of it because I talk about it.
You do all right, yeah.
I could have built a much better portfolio than I have done, but it's okay. It's good enough, and I've still got time.
Mate, I think anyone, the honest response to that, in my opinion, mate, I've got a big portfolio now. Honest response to that is everyone who has built a big portfolio looks back and goes, I could have done this better, or I could have done that better, or I should have gone harder here. I look back at Sydney and I was like, I face palm myself 10 times in a row because I knew of what I knew I could have bought that has quadrupled since then in 10 years.
Yeah.
But mate, I've done pretty well. You know,
you've done better than pretty much anyone I know. You've built a better portfolio than I have. Like you've been a lot more active, engaged and stuff.
That's
and
my
it's bigger than it's. I think it's probably
right?
it's quite a lot bigger than mine.
But property is also my business, right? So
property's your business.
Yeah, for you, it's Momentum Media. It has been for a long time. For me, property was everything. When I was super low income, that was all I did.
Property. That
was it.
Yeah, I sort of, whenever I catch up with people like you and other buyers agents I know like and respect, I go, I should really do more than I get it out of the studio. Just someone else comes up. But like this is the challenge being a property investor and doing something else, right?
Yeah.
Like if you're in it all day, I reckon I'd probably do more buying. But that said, I could probably do a lot more buying anyway. But anyway, I'll work on it. If only you told me where to buy, I'll go and.
Maybe you need a good buyer's agent.
Maybe I do need a good buyer's agent. Are they out there? Do you know where do I find one?
I'll pass you a card. Here we go.
Yeah. There's one thing I'm not short of is people I can talk to about property.
That's it. Yeah, for sure.
I'm not short of it, whether they're accountants or buyer's agents or brokers and stuff like that. But what I actually wanted to talk to you about was rent vesting, and it's not a term I particularly like.
Okay.
But let's
Why?
have
Why
a
don't you
chat.
like it?
I don't like the term.
Why?
I like the concept.
Okay.
I dislike the term.
What would you call it if we renamed it?
I don't know. Let's work it out when we come back from a break. Back in a moment. Welcome back, Phil Tarrant, SparkPoint Investor. Having a chat with Sam Gordon. I'll never call you Sammy.
Sammy Gordon?
No. What else is there? What do people call you? Got
it's just
names,
that.
Yeah.
Yeah.
Is your real name Samuel?
Yes.
I'm going to call you Samuel.
All right.
Samuel Gordon.
You're literally the only person. Even my mum calls me Samuel.
I'll call you Sam. Sam's easy. Sam Gordon. Australian Property Scout. Now, rent vesting.
Yes.
I think it's a great concept. I don't know who coined it. And I remember it probably started rearing its sort of head as a name about 5 or 6 years ago. Did you? You didn't coin it.
I didn't coin it. No.
It's just for some reason it's always annoyed me as a term.
What else would you call it, but you rent and you invest?
Isn't it just investing?
No.
It is.
No, because like the strategy is renting while you're investing as opposed to owning your own home.
Isn't it just investing though, and not owning your own home?
But it depends if you use it as a strategy, because there's people who.
But what you're assuming there is that there's an expectation.
Yes.
That you buy a principal place of residence.
And tell me in Australia that's not the case.
Well, that's cultural consideration, right? Yep. So when is it going to be? There's going to be a tipping point.
Yes.
Where less people own a principal place of residence than own a principal place of residence.
Yeah.
Now, I don't think we're far away from it. I don't know the numbers exactly, but it will be a point where buying a principal place of residence isn't the majority.
Yep.
It will become the minority. And minority might be only 49%, right, of the 100% of people, right? But, you know, as a nation, we've gone through this cultural evolution or endeavour of saying there's a right and expectation for every Australian to own their own principal place of residence, and that's a God-given obligation. And there's a lot of people who are coming to the realisation that they're never going to be that person, right? So hence the reason why someone comes up with a concept going, oh, well, let's call it rent vesting, right? It's just investing.
Yeah.
And, you know, if you live at home with your mum, right, and you're a property investor, what are you?
You're just an investor.
You're just an investor. You're not like a live at home with mum investor. You know what I mean?
Buy investor.
It just I don't know. It just means you're not deploying capital and debt into something that you choose to live in.
And I think that's the thing.
It's a term. I want a new term for it.
I get that. I get that it annoys you. Maybe we'll try and come up with something different. But for me, like when I look at it, though, it's like it's probably you could maybe scrape together to get into a house. And I think this is the thing, right? Like, and so many people when they go to buy, this is where I think exactly as you're saying, there a huge amount of people are shifting and going towards this avenue because they figure out what they could buy with what they make or how much they've got, and they're like, you know what, like I don't want to live in that, or like that wouldn't make, if that's all I can afford, I don't want to do it.
Yeah.
So then they opt to rent while they go and invest. So like I think it's and like I can talk about this very openly, like with myself, because I actually bought my first home as a primary residence at 19, and I lived in a primary residence until
Why'd you do that?
27.
You're a madman.
Well, it's the first time owners grant. At the time.
Your first property was as a principal place of residence. How long did you live in it for?
About 18 months.
Oh, wow.
Yeah.
Okay. So you
Down in
probably had to
Wollongong.
have it 12 months, right?
Yeah, I think it was, or 6 or 12 months. I can't remember exactly
It's not a
what
bad
it was.
way to start.
Yeah.
Yeah.
It was what I needed to, like, it was what I actually didn't have enough money to buy a direct investment anyway, because I needed the grant and I needed the stamp duty exemption. So I actually, to be honest, I wasn't even looking at
Did it at 19?
renting. Yeah.
That's crazy.
Yeah. Did you not know that?
I knew you started young, but
Yeah,
not
yeah.
as... Okay.
Teenager, yeah. Yeah, first one at 19, so, yeah.
It's pretty cool.
Thanks, mate.
Yeah.
Yeah. So I lived in that one for a while, and then I built.
So you didn't rort it like I know a lot of people have done.
Nah,
where
mate, I needed
they
it.
get all the grants and stuff, and then they go, "Oh,
I'm
can I
living
just
there."
send my mail to?" You go, "Nah."
I've known a lot of people to do that as well.
Yeah.
But no,
I'm telling
I,
you, don't. If you're tuning into this, don't rort it. Don't rort it because you will get caught. And
they're onto it these days, aren't
mate,
they?
they are, and rightfully.
Yeah.
I don't like people rorting, like deliberately rorting. It's not cool. But it's the data matching capabilities now of the tax office. If you rort it, you'll get found out. And when you go, "Oh, I didn't know. I didn't know it was like," come on, like, and you will get fined.
You know what the other big thing is now, though, mate, is almost all the grants are relevant to new builds.
Yeah.
And so, like, when you do a new build, it's so hard to make money on new builds, and it's not on existing property. So if it's not on existing, like, and it is on that new build, and you're in a very precarious build environment
It's
at
a
the
massive
moment.
handbrake. And that's
Yeah.
why I sit there and I was reading the paper this morning. We got the new housing minister, Claire O'Neill, who was the Minister for Home Affairs and Cybersecurity up till about 2 weeks ago. She's now the housing minister. And she's trying to push through this. She's saying the most important thing on her agenda right now is getting first home owners into houses.
Okay.
And they've got this new scheme. Was it 40,000 homes? Was it built to rent or where the government takes a bit of equity in it? I can't remember the scheme. Help to buy scheme. Or
Yeah,
something.
right.
I probably got that wrong. Something like that, right?
Yep.
And where there's 40,000 homes that the government will go, yeah, we'll go in with you. We'll take 20 or 30% equity.
Yep.
I can't remember exactly the numbers you put in the rest, get the debt and all that sort of
Yep.
stuff. And that's their headline policy right now. And the Greens and the coalition are going. And even I saw today the housing industry of Australia sent through a press release pretty much going, like, that's not the main game.
Yeah.
That's shades of grey around the fringes, right? Where's these 1.2 million houses that you're supposed to be building, right? However, the point I'm making is that you probably dodged the bullet in some ways. But if they incentivise people to get into new homes by providing grants around a new home, if you buy a new home off the plan, land and house and development stuff, you probably could have bought something better with your money. And I'm not going to go too hard on that, but there's a lot of fat in those properties. And if you're just going to buy that home, you're going to live in it forever, for 30 years, and maybe try and, do some smart debt management where you might pay 13 repayments instead of 12 and cut it down to 17 years, whatever. Like, you're probably not going to be a property investor.
I think the interesting point that you said on the back of there as well, it's if you're going to live in it forever, right? And I think the idea that someone's going to live in their first home forever, it's complete nonsense. You're not going to, right? And so there's a few things there to kind of even unpack within that, because your house and land packages and your apartments that are getting built new, they're 2 to 3 years away. So that's like dead money you got sitting in there waiting for that thing to kind of potentially come to fruition. And that's if it valves up, right? And if it doesn't valve up, you might even have to walk away from the deposit.
Probably a good chance it won't valve up.
If it valves short, hey, that's happened heaps. Like it's so many times.
It's not
in history.
guaranteed. It's not guaranteed it will get the valuation you think it will do.
Yes. And then if you can't settle on it, like you might have to walk away from it, or you might have to stump up more for a property that's actually worth less than you paid for it. So there's a lot of risks associated with that. I'm not a fan at all of that. When it's funny, back when I did it, it was a very different environment because land was a lot cheaper. Builds were a lot cheaper as well. In the last 3 years, like builds have pretty much doubled.
Yeah.
Land significantly more expensive than 5-10
back
years
then
ago
it
as well.
was $7,000 probably. I think it was a 14 grand back then. And
It doubled to the 14,
exception.
and then it dropped to 50% of that. So it was 50% of the extra. So it was 10.5 plus stamp duty exemption.
Yeah.
So it was good.
It was enough.
Yeah, it was good. Man, it got me in the door. And I think this is like, at the time, it was a stimulus of what they were trying to, fire up with the economy a little bit. It was straight after GFC. It was in
Trying to get
2009.
building going and all that sort of stuff.
They doubled the grant for new builds as
It
well.
doesn't even move the needle these days. Like, and a lot of people go, yeah, I've got to buy that house because I get a government grant.
Yeah.
it's probably not the right way to go about doing it, right?
Yeah.
Because
And this is where I think, when we bring the conversation back to rent vesting and we have a really good look at actually, what someone's trying to achieve out of their portfolio. And this is why I've actually got a lot of clients here that they've outgrown the house that they're in, and that might not have even been their first home. They might have had a first home and then gone to the second, and then they've outgrown it. And they're like, we're gonna have to move again. And we look at the entry and exit costs, and it's still not going to get them in their dream home. And a lot of times this is where we'll sit down and we'll actually have a strategy and we'll work this thing out. And we're like, okay, so what is the dream home? And they're like, well, we're selling out of something at 1.5 or at 1, and now we're about to buy something for 1.5 mil, because that's what we need size wise and everything to with the family or whatever's coming. So okay, what's the dream home? Like, oh well, it's the $3 or $4 million home, 30 minutes this way, whatever, with this sort of style house and sort of thing. And it's like, okay, how committed are you to actually get that? And like, well, that's why we're investing, because we want that. It's like, okay, so the decision to jump from 1 to 1.5 mil, for one, you're gonna hammer your borrowing capacity. Because the banks don't look at your own home as an asset; they look at it as a liability, because it's non-income producing debt. So you're gonna take on more non-income producing debt, become more of a liability to the banks, and they're gonna obviously lend you less money. So what we're seeing a lot of these guys do is actually go, you know what? I'll sell that house because I've made good money on it. It's a primary residence tax exemption from selling this thing off, and I'm going to sell that. I'm going to clear let's say $600,000 worth of liability debt there, and I'm going to clear $600,000 worth of cash profit difference there of what I've got in there, and I'm going to go rent that 1.5 mil house for $800,000-900,000 a week, and instead I'm going to go invest the rest of it and build it from there. And we've seen this huge transition. I've been talking about rent investing quite a bit now for probably the last 12 months. I think because I still do it, and people ask me and they try and like, oh, well, if you've got such a big portfolio, why don't you buy your own home? I was like, well, if I can. This sounds a bit silly, but if I can rent like a $5-6 million house for $1,500, $2,000 a week, if I actually weigh the two up, I'm saving like $5,000 a month, in ownership or more in ownership of it.
Mate, you said I did it for
yeah.
I think it's brilliant. You live where you want to live, and like sometimes it can be you got to be willing enough, but you can structure it well as well.
Yeah.
That you might have a little bit of a transient life.
Yeah.
Which might not suit everyone.
Yeah.
If they've got kids and stuff, it might just be hard. But if you can actually negotiate really smartly if you go down the pathway of being an investor. Like, you don't think that you need to sign a 6 or 12 month rental agreement. You can sign long-term rental agreements with people. I know people who rent vest who go, yeah, I'll rent this place, whatever, and they could be paying, they could be living a $5-6-7 million house, which would be unaffordable, but they could still live in benefits of it, and they paint it, they do renos and stuff. Like they'll have a 5-6 year, 3 year, 2 year, 1 year like lease agreement and stuff. And they go, to make it the right, and they're ahead of the game.
And they're significant. That cost, that ongoing cost, right? Or especially with that mortgage, especially with current interest rates compared to where the rent is, it is a ridiculous saving compared to owning it, compared to renting.
Well, the key thing is that debt on your principal place of residence is not tax deductible.
No.
And a lot of people go, yeah, but when I sell the property, it's capital gains tax
free.
Exempt.
Yeah.
And land tax free in some ways.
Yeah.
And people go, well, it's cheaper to hold and I get the benefits from it. But it's all about deploying your capital effectively.
Yeah.
And when you do the math and you sit down your accountant, you look at, the benefits of being able to associate the expense of holding that property through the debt that you pay as a business expense, and therefore it supports with your tax situation, the numbers dwarf any potential outcome and not having to pay the capital gains tax.
I think the other huge thing there is like, even if you said that, I was like, well, when I sell it, it's like, okay, but like if it's not your dream, if it's not the end game primary residence and you're an active investor, what is the actual point of buying it? Because all it's going to do is hamper you, impact everything you're trying to do, because you can probably rent the same or very similar to it, as we're saying here, significantly less, which keeps your borrowing capacity really strong, keeps your serviceability really strong, keeps your debt and capital free. So you can actually build the wealth towards owning that thing at a much lower debt position, or potentially outright at one point. But at the end game. So you can also build out the passive income portfolio at the same time, but then potentially build out the capital gains side of the portfolio to then be able to own that, but own it at the back end, so you can still build the journey and build yourself there. Because what a lot of people miss is the entry and exits of getting in and out of even 1.5, then you step to 2 mil, and then we're trying to get to 3 mil home or 5 mil or whatever it costs. The entry and exits on those things are massive. Stamp duty, sales costs.
Capital. It's not stamp duty exempt if you're buying principal place of residence, right?
Like 100%.
If you're buying big bicky properties, like it adds up.
And the sales comms on the way out as well.
Yeah.
Like they all add up, you know? And so like, okay, you might save bid in land tax, but the thing is land tax, you don't pay land tax on a rental either, you know? So I think like when I weighed everything on the table, right? Like I laid it all out because I started rent vesting at 27 or 28. I'm 34 now, and the change in my portfolio in that time frame has been immense. It was even before I started the business as well. It was a year or two before I started the business. And that additional borrowing capacity, obviously I'd learned a lot of different things. I learned a lot of strategies and I was applying some pretty active sort of things within my portfolio as well. But the increased serviceability that I got from that allowed me to do so much more. And I've just embraced that and gone further and further. Because what I realized was the house I was living in was a $750,000 house south of Sydney, right? And then I moved into $1 million house that actually I was renting for cheaper than I could rent my other house for. So I moved into that. And then the next one was probably worth about $2 million. And then the next house was worth $3 million. And the rents don't even go up that much because the pool gets smaller and smaller. Yeah. And if I had actually upgraded every 2 years in terms of actual purchase price, I'm paying those entry and exit costs each time I'm moving. And so instead, like, there's two ways of looking at it. Yes, there's the stability side of owning the thing, but then there's also a flexibility side from the rental as well to kind of move around and kind of, you know, change that lifestyle perspective as you go through there too. So yeah. I think it's weighing everything on the table. But ultimately, if you want to build a big portfolio, primary residence early is just going to hold you back. Whether you've already got it now or whether you're looking to put it in a couple of years, what I almost always urge is build out the investment portfolio first of what you want to achieve. Whether that's a 150, 200,000 net passive portfolio, 400 grand portfolio, whatever it is, even if you haven't actually achieved that yet. But if the portfolio is being built, but you need to go through some consolidation to get to that point. Once you've built the portfolio, then you can go and do it if that's what you really want to do, or you just keep building the portholio.
Yeah, it gives you a lot more choice.
Yes.
I'm an advocate of it, but it's
just not the name.
Horses for courses. But you get continuity with your property investment portfolio and choice, right?
Yes.
If you're locked into a principal place residence, like, you know, if you go all in, maximise your serviceability on a principal place residence, good luck investing in property.
Yeah.
And this is the reason why, one of the reasons why most Australian investors only own between 1 and 2 properties, right? Because they're probably all in on a principal place of residence in a location where they want to live and want to keep up with the Joneses and the kids go to school there and all that sort of stuff. People usually max out on their principal place of residence and leave no fat for the other stuff.
Yeah, because when it's a primary residence, they want the best of what they can afford, right?
Yeah,
and so once they max that out, it's game over.
Yeah, but you can still get the same though if you're got the mindset right to rent in that same area.
Yeah. You know. I think the crazy thing is, like, a lot of people think they're keeping up with they are, right? They're keeping up with the Joneses or whatever, or they're keeping up appearances. And the crazy reality of it is in, like, if you do this, we'll call it a sacrifice, even though you can probably rent almost the same thing, but for considerably less from renting it compared to owning it. The sacrifice of that, maybe over like a 5-year period of investing hard instead of owning that primary residence now, you're going to be able to afford a significantly better home in 5 years than what you would buy now. And I think that's where, and I didn't realize that until probably the last couple of years, where I kept thinking, oh yeah, I'd love that home, or I'd really like that home. And then it went up $1 million, and then it went up another, and then it starts going up by bigger increments because my portfolio gets bigger and I can afford something bigger, right? Your tastes change. And so this is the biggest thing is, like, you're undoubtedly going to outgrow that place anyway. And so if you can outgrow it and it's going to hamper you from your journey, why let that handbrake or that anchor be there in the portfolio instead of letting it free? Yeah,
and these are what you need. And you probably find people tuning these podcasts get it. It's people that don't get it right. And they're brought up with these preconceived ideas of what property is. And the first one is to the point that I made, that there's an expectation that every Australian should be able to buy their own home, right? You know, there'll be a point where that's not, and I don't know, I need someone smarter than me to tell me how far off we are from that, right?
I'll do the numbers when I come back to
you. Well, they say that, you know, a third of Australians own their properties outright, a third of Australians have a mortgage, and a third of Australians rent, right? So on that basis, you would assume 33% of all Australians are renting, right? So that will change. So we're still some way off that tipping point. But then you have all these people who have a principal place of residence with debt against it. That's probably the third with mortgages. Like, how many of them probably would be better off if they didn't have that and they were renters. So
I'll give you an example. In our team, one of the buyers agents, Jace, he lives in Cronulla, right? And or he lives in the Shire, and a big bunch of his mates, they all went out and bought a couple of years ago when interest rates were super, super low. And they all went and they all maxed themselves to the max.
Principal place residences.
Yeah. When the interest rates were super, super low. And he couldn't afford it at the time. He could only afford to rent, right? And so, but he felt like he was missing out, and he felt like they were all killing it because they all bought their primary residences. Fast forward like a year, 2 years when interest rates went up. And this isn't obviously having to dig anything like this, but they were all like stressed to their eyeballs because they were they kind of bought to their max, even with obviously serviceability buffers in there at the time when they did it. But then the interest rates grew beyond the serviceability buffers, right? So that was at stress points. They've all been stressing for 1-2 years, and he's gone and built himself a $2.5 million portfolio on the side. When he started with, he literally had a deposit, you know what I mean? He started with that. He's built that portfolio, and he's got a couple of deals that he's got in Perth that they're his deposit, but they'll be $1 million deposit when he sells them at the top of the cycle to then go and buy the primary residence. So debt's going to be significantly lower. And he's sweet. He's not stressed. Like the portfolio is paying for itself.
And what's he missed out on?
Nothing. The stress.
Yeah, and that's the second point. So the first point is everyone should have a principal residence, and that's what Australians do. The second point is rent money is dead money.
Yeah. What a joke that is.
And you've just given a great case study. Like, I'm sure all these mates are going, why doing that? Don't do that. Like, buy a place. And they maxed out with interest rates at 2%.
Yep.
Even though it had a 3% buffer, 5%, when really they were probably redlining anyway and didn't really do their budgeting in the right way anyway, right? And this is so that they're probably now stuck in a principal place of residence forever.
Yeah. Yeah, potentially. Yeah, and they definitely have a serviceability to invest either. So like they're stuck there, they're trying to pay it off, and he's literally told me like they're all stressed out of their minds. Like they're all stressing big time about it as well. So it's because I remember he actually asked me when he had the chance at the very start. He's like, they all bought like quite nice, expensive houses and stuff. He's like, oh, should I just, get into the Shire and just get a unit in Cronulla or something? And I go, man, if this was me, I'd keep doing what you're doing now. You're living at a low cost base. You're going to be investing buying beyond your means, buying something like that. I'd start with this sort of house, takes care of itself, buy at a discount, buy at the bottom of the cycle, and now he's laughing. Portfolio's growing, still building, no stress whatsoever from that side of things. And it's a great position, and he's built. It's part of the strategy of what he's built towards those first couple of deals.
Well, it gives you choice and flexibility, right?
Yeah.
And you think about it, those if he wanted to pull up stumps and go travelling, he could do.
Yeah.
It's very hard for. If you've got a principal place of residence. Yeah. Very, very hard.
Yeah, for sure.
You're stuck, right? So be careful what you wish for. That's why rent vesting appeals to a lot of people. So, I'm all for it. I think it's for the right person. It's the right strategy.
Yeah,
not right for everyone.
Yeah. It's always case by case. And I think one of the other things is like if you own your home and let's say you bought it 10 years ago in Sydney and the thing's doubled or quadrupled or tripled, whatever, it's had significant growth and you're at a very low debt level on it, this probably isn't relevant to you. Yeah. But it more than likely isn't, unless you can't afford to extract equity and then go and invest elsewhere. Maybe it's a conversation, but for most people who are in that situation, it's probably not. Yeah. But for people starting out or they're tossing it up or there are a couple of investments in, and especially if you've made good money off them, some people are like, okay, well, maybe now's the time to turn it into it. But it's one of those things, if it's working for you, just, if something's working for you, keep going with it.
Sensible. So people want to understand more about that. You're happy to talk to them about rent investing?
Yeah, of course. Of course.
You love it?
Yeah, mate. Honestly,
are you going to rent vest forever?
I will eventually buy something. I think when the investing journey's done, if it's ever done, I don't know. I always say I'm going to have a break, and then I go on a bit of a buying spree.
Yeah.
But mate, it's for now it's working for me really well. I'm also like I'm not 100% set on anywhere that I really, really want to buy.
Right.
So if I'm not, I don't want to go sink.
You might not live in the Gold Coast forever. I think you probably will do.
Who knows?
Anyway, that's Sam Gordon. How do people track you down, mate? What's the best way?
Mate, socials are super easy. So over at Australian Property Scout is the easiest one, or Sam Gordon Property.
Did I see a fake profile?
You
a social media profile?
Did you report it for me?
No, I don't even know how to do that.
Oh, okay.
Was it samproperty.au?
That's the one. Yeah, we got onto it quickly. Did
they shut it down?
Yeah, it got shut down pretty quick.
Was someone just trying to?
They took all the photos and stuff, and they put up there, took the stories, they put it on there. So, and I had a few mates message me, and like someone had just like messaged them off the profile. So we got it. Mate, I never went for the. I didn't want to be one of those guys with the verified ticks. You know what I mean, like the blue tick. But I was like, oh god, like you know what I mean. If someone's trying to impersonate you, we're kind of in the financial industry.
There's a lot of it these days, right?
Yeah.
Dis and misinformation, and people pretending. People just assume that they're speaking to the right person.
Yeah,
right?
that's it. So yeah, mate. Yeah, so we jumped on
life. So the real social media is Australian.
Sam Gordon Property. That's the first one. And then Australian Property Scout. And then, if you guys want any more information or listen to us as well, you can have it as Scouting Australia Podcast, AustralianPropertyScout.com.au. We're pretty much everywhere.
Everywhere. Miss him. Well, thanks for coming in, mate.
Mate, absolute pleasure. Thanks as always for getting me on.
Yeah, we always mix it up.
That's it.
Get into it. But, let's come up with a new name for it.
We'll come up with something.
Great concept.
Yep.
Great strategy. Stupid name. Yeah, that's all I'm saying. Thanks for tuning in, everyone. Remember to smartpropertyinvestment.com.au. Social media, find us, Smart Property HQ or Smart Property Investment, wherever you choose to get your stuff at. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.